Hey everybody, Josh Bennett here with Money Masters, the channel where we help you earn more, keep more, and grow more money. In this video, we're going to talk about a topic that I've been getting this question all the time lately, and that's, will COVID-19 or the coronavirus affect my retirement? When determining whether COVID-19 will affect your retirement, there's really two things that you need to look at. One is obviously the stock market. That's the one that you see in the news all the time. That's the one that gets kind of the most publicity. So we're going to look at sort of my outlook, what data points I'm looking at, and how the current stock market could potentially affect your returns and your retirement long term. But one of the more important things is actually how the government and the Federal Reserve are handling their response to COVID-19. That could actually have a bigger impact on your retirement, and we're going to dig into why that is here in this video as well. One of the first things to consider with COVID-19 and whether that's going to affect your retirement is to first take a look at the stock market and your investments. And the reason for that is your savings and your investments play a huge part on your ability to have a successful retirement or really be prepared for retirement. And if you're a millennial, this could be something that you have a great opportunity right now, but it's something you also want to really pay attention to. Now, as of the recording of this video, we did see a pretty large drop, in the range of 30% from the highs that we had back in March to some lows that we saw just due to the initial shock of the coronavirus or COVID-19. That being said, since then, the markets have rebounded pretty quickly. And a lot of questions are out there did we see the end of the bear market or, in other words, downward market, or is this only the beginning? Well, when it comes to predicting stock market returns, there's no real science to it. I mean, there's a lot of science to it, but no one really has a crystal ball that can tell you exactly what the stock market's going to do. It all becomes just sort of conjecture based on data. To put it in sort of layman's terms, for example, say you're at Costco or Target. Pre-coronavirus, obviously, things have changed a little bit with this analogy, but say you're at Target and you're trying to pick out what line to check out. And, and say it's a busy Saturday, so there's just lines backed up and there's 10 different lines open. Well, you have no real way of knowing exactly which is going to be the fastest line, but you can look at the data to sort of interpret and take a guess at what the best line is going to be. So, for example, you can either get behind the person that has 5 items in their cart, or you get behind the person that has a cart chock full of things plus 2 kids that are running around screaming that the person's having to watch after them instead of putting the things on the turnstile to get the checkout faster. So when taking a look at that data, obviously you're going to stand behind the person that only has 5 items. We can do sort of the same thing when it comes to the stock market. We can take a look at what is the data telling us, and is this going to be the best bet that we can make? Obviously, there's no guarantees in terms of that's going to be the right situation because, just like with checkout lines, you could always think you're getting on the right line and then find out that the person that was actually doing the checking out in the line with the 2 crazy kids could be one of the fastest people at scanning that you've ever seen. But you just have no way of knowing that because you can't necessarily see all the data and process all the data. There's going to be things that are just outside of your scope. So you have to do the best with what data that you are given. So what is the stock market data telling us right now? Recently, I recorded a video showing that I actually thought the S&P 500 pre-coronavirus was due for a recession anyways. And a lot of that's due to the current valuations that companies have. So from a very limited perspective, when we take a look at is the stock market worth investing in, what are valuations in the stock market, it really comes down to what are the companies worth versus how much they're making. So if the company's worth too much compared to how much it's making, it's considered overvalued. So for example, if you could buy a company that's $500 and will give you $100 a week, that's more valuable than a company that you can buy for $1,000 that'll give you $100 a week. Same sort of concept when you're buying in stocks. Well, right now, companies are, even with the declines we've recently had due to coronavirus, are still at some of the highest valuations we've had in history. And that's including 2008, 1999, when we had the tech bubble. So we're at some of the highest valuations in history, even after the crash. So that being said, there still leaves a lot of room for valuations to decline to long-term averages. Also, due to the recent rally that the S&P 500 has had, in terms of the trend of the actual downfall, the S&P 500 really hasn't even started trending down from a long-term perspective. So there, again, is still room for the S&P to really get some momentum on the downward trend. So that way we'll see potentially lower prices long term, because again, it's just sort of at the tip of that roller coaster thanks to the recent rallies we've had. And with that, the recent economic data that we've had is actually pretty bad. So when you look at what the stock market is going to do, one of the things we have to take into account is what's the economic data. So I mean, really, stock market is just based on what businesses are doing, what the economy is doing. If the businesses are doing well, the economies are doing well, then stock markets tend to go up. That being said, if the economy is doing really bad, businesses are doing bad, the stock market should go down. That's just the nature of how things work. So that being said, right now we're seeing two very different lines. We're seeing two very different pictures. So economic data coming out is looking very bad, whereas the stock market has been on a recent rally. So let's take a look at some of that economic data that's been coming out and see sort of why this paints a picture that we're probably not going to be going much higher, if at all. We're probably going to be going much lower, at least for the foreseeable future. So China, who was one of the first countries to really get hit by coronavirus, because a lot of speculations are that's where it originated, we're starting to see some of the economic data that has come out of China and what the impacts are there, since they're a little bit ahead of the rest of the world in terms of the economic impacts. And when it comes to China, so China posted their first record ever contraction in quarterly GDP, or basically how much the country is producing based on coronavirus. So the amount that the country produces decreased by 6.8%. So again, the amount the country produces decreased by 6.8%. And that's in a huge economy with 1 billion people. 6.8% may not seem like a lot, but that's a really big number. And it shrank that 6.8% in the first 3 months of this year. So in only 3 months, it shrank by 6.8%. And this is for a country where the GDP growth has been either in the high single digits or even double digits in terms of growth over the past couple decades. So it hit this big, an economy that's been growing as fast as China has doesn't bode well for the rest of the world. Here locally in the US, one big factor is unemployment. So right now, due to the coronavirus, we have massive amounts of people being unemployed and record levels each week that we're seeing in terms of people that are getting, you're filing for unemployment. So when you have people unemployed, they're not buying goods. Even if they're getting unemployment checks from the government, which they are, it still concerns people that what's the future of their career going to be? Are they going to be able to get their job back once coronavirus ends, once we flatten the curve? Are they going to be able to continue working, continuing to get a paycheck? Or are they going to rely only on the government? It creates a lot of doubts in people's minds, which basically makes people concerned. And one of the other things we're seeing is people less likely to buy a house, which again has a huge, massive effect on the economy. And so when people aren't buying houses, home prices fall, and that's a big component of the U.S. economy. We're also seeing confidence, aside from just unemployment, drop pretty significantly. So for example, now in America, over 50% of people feel like the financial situation is getting worse. And when people are unconfident with the economy, they don't spend money. And when they don't spend money, companies don't make money, the economy tends to crash. And also the stock market tends to crash. So these are things that don't necessarily happen immediately, which is probably why we're not seeing the immediate impacts in the stock market. But when people aren't confident, they don't spend money, and then companies don't make money. So that is going to have a huge implication on where the stock market goes. And with that, we're already seeing the implications when it comes to actual companies. So one, companies are going to start posting earnings here very in the near future that's going to actually reflect what's happening with coronavirus. And that's where we're going to get a really good picture on how much the economy is being impacted. But things we're already seeing is like the weekly economic indicators, for example, that were created to test the impacts of coronavirus are showing 2008 levels of bad economic data. So we're seeing the same kind of economic data that we saw in 2008, which had a resulting stock market crash of around 50+%. So we're seeing those same numbers from weekly economic indicators in the US today. But I mean, one factor, for example, is inventories are drastically increasing to 2008 levels. So what that means is companies have inventories that have come into stock, but there's no one there to buy them. So if no one's buying inventories, again, the company's not making money, which ultimately will later on affect their stock value, just because, again, if you have $500 in a company that's paying you $100, that's more feasible than a company that's only why would you pay $500 for a company that's now only going to pay you $10? Again, if they're not making the earnings, not giving you the return on your investment as the stock owner, the values of that company are going to drop. So these are some indicators that show why the stock market is likely not over the pain. And we will likely see, 3 months, 6 months, a year, whatever the case may be, continuing down markets. No one knows exactly how long that'll last. For example, this up market that we're currently in could last for 3 months on optimism now that the coronavirus is starting to look like that, there's getting a handle on it. But long term, economies don't move very quickly. And as we see this data dripping out, it could continue to drop the stock market. Again, no one knows when, how long it'll take to recover, or when we'll see this next big drop, but it's more likely to continue down than it is going to be to continue upwards. So the second factor that could have a drastic impact on your ability to have a solid retirement, especially if you're a millennial, is actually what the government's doing now to have an effect on you're trying to prevent the coronavirus downfalls. So what we're actually doing is we're sort of sacrificing our future selves for our current selves. And I'm going to show you kind of why that is. But really, these stimulus packages, the government has, right now already committed over $4 trillion between the Federal Reserve and the federal government to combat the coronavirus and the economic impacts that are coming from the coronavirus. Well, that has a drastic impact on our future ability to retire. And to paint a picture, here's a clear reason. For most Americans, the main source of retirement funds are Social Security and 401ks, or some sort of other tax-deferred retirement accounts, such as 401k, 403b, pensions, things like that. Well, let me ask you a simple question. Do you think taxes will be higher now or later? Well, common knowledge and common assumptions and why you use tax-deferred accounts, or accounts that you get a tax deduction today, but then you pay taxes later on in retirement. The reason for that is most financial professionals and things like that will say, during your earning years, you're going to be making more money than you'll be spending and therefore taking in retirement. So therefore, the total taxes you'll pay will be lower in retirement. Well, let's take a look at an example. This is a $5 bill. So not very big, pretty tiny. So now imagine this was a $100 bill. So a $100 bill, again, same size, not very big. $1 million of $100 bills can fit into a duffel bag, or grocery bag. Again, not very big in terms of $1 million worth of $100 bills can fit in just like a bag you could fit in your overhead compartment on a plane. $1 billion with a B covers basically a standard size pallet. So not a big amount. $1 trillion covers about the amount of a football field. $1 trillion in $100 bills. So it covers about a football field filled with pallets of $1 billion, right? So the amount of debt that we have in our country right now is significantly higher than that. So right now, we're almost at $25 trillion in U.S. debt. To put that in perspective, that's enough $100 bills to turn, say, Lambeau Field or a NFL-sized football stadium into a pool of $100 bills where you could essentially Scrooge McDuck, jump off the top, and start swimming in $100 bills. So literally could fill an entire football stadium with $100 bills. That's a massive amount of debt. And to further put that number into perspective, right now the U.S. makes about $3.5 trillion a year in terms of revenue. So how much money they're making about $3.5 trillion a year. So even at that, it's going to take almost 7-8 years if we dedicated every dollar of that to pay back that debt. Well, we obviously can't do that because we have bills to pay in this country. What are our bills add up to? About $6 trillion. So right now, the U.S. government is spending $6 trillion and only making $3.5 trillion. So we're spending $2.5 trillion more than we're making each year. So basically we're going further and further and further into debt that we're not going to be able to pay back because we don't make enough money off taxes in our country. And to add to that, not only do we have the $25 trillion outstanding of debt right now, we have $122 trillion of committed liabilities, things like Social Security, Medicaid, Medicare, things like that we've already committed to that we're going to owe money for. So $122 trillion that we cannot fund outside of the debt that we've already incurred. So by having this debt, the amount of debt, it's got to be paid from somewhere. And really the only result is that taxes are going to be increased. And they're going to be increased sometime in the future, and probably pretty drastically. So that means that millennials, one, it's likely that we might not have Social Security, 20, 30 years from now, or it may look entirely different. And two, the main source of most people's retirement funds are going to be taxed pretty heavily later down the line. And so that's just going to take away your retirement funds. So all in all, that's going to have a big drastic impact on your ability to retire, is because these things are going to eat away at your retirement ability. No Social Security and your 401k not being worth nearly what it is today, that's going to have a huge impact. So what are some things that you could do? One, with the potential downfall of the markets, you could have some pretty awesome buying opportunities if you invest well. So in this type of market, when you do things like dollar cost averaging, or where you systematically invest into the markets at regular intervals to buy as the market goes down, you're just buying stocks on sale. And when those stocks recover, which ultimately they most likely will, maybe not tomorrow, maybe not 2 years from now, but when you're talking about retirement, which is for some people 10, 20, 30 years down the line, it's likely going to go up, and it's going to go up, based on history, pretty significantly. So if you can invest when those stocks are on sale, that just boosts your ability to earn wealth long term. So investing early, investing often during this type of situation is going to be very beneficial. Another thing you can do is utilize things like Roth IRAs. So instead of just saving in your 401k, focus on things that are tax-free. So you pay on taxes today, but you never pay taxes again after that, as long as you follow certain stipulations. But things like Roth 401ks, Roth IRAs, certain life insurance policies, these are ways that you can build up your retirement funds tax-free. And if you can get as much money as you can into these type of plans now before potential tax laws change, and these sort of things may go away in the future, but if you can take advantage of them now while we have them, you might as well. So getting things into tax-free retirement accounts, such as the Roth IRA, that's going to be a great tool that you can use for long-term growth and sort of to, I don't say take advantage, but to use this coronavirus situation and work with it to make sure that your retirement is still protected. So those are a couple things that you can do. Hopefully you found this video valuable. If you did, make sure you like and subscribe. We'll try to send out as much valuable content as we can. But if you subscribe, you'll be notified anytime we throw out a video. But again, hopefully this was helpful. If you have any questions, make sure you leave them in the comments below. We'll try to address as many questions as possible. Cheers.